Welcome to this presentation by Facilitators Research. This research is distributed exclusively for informational and educational purposes and does not constitute financial, legal, tax, or investment advice. For such services, you may reach out to speak to one of our officers.
Lesotho, a small open economy, pegged to the rand, exposed to commodity cycles and global rate shocks. For over 2 decades, its interest rates and inflation have told a story. This is the institutional investor's view. 5 periods, 5 sets of decisions. How should a chief investment officer have interpreted each 5-year window, projected the next, and positioned the portfolio? 23 years of monthly data from the Central Bank of Lesotho and the Bureau of Statistics. 11 interest rate series. CPI inflation. All numeric, all verified at source. We divide the timeline into 5 periods, each approximately 5 years, and analyze each as a CIO would have at the time. The framework is simple. For each 5-year window, the CIO looks backward at what happened and forward at what comes next. The real interest rate, nominal rate minus inflation, is the true cost of money. When it is high, bonds and deposits win. When it is low or negative, real assets and equities win. The portfolio mix follows the real rate. Period 1, 2002 to 2006. The policy rate fell from 16 to 11%. Inflation rose from 3 to 6%. The real rate averaged 7.5%, peaking at 9.6 in 2005. This was a golden era for fixed income. Lenders captured windfall carry as funding costs dropped. Bondholders locked in double-digit yields. Looking forward from 2006, a CIO would have projected continued rate normalization and stable inflation. The portfolio mix. 40% long-duration government bonds, locking in the high yields. 25% fixed deposits at 5.5%. 20% equities, riding the commodity cycle. 10% T-bills for liquidity. 5% cash. The real rate was still strongly positive. Fixed income dominated. Period 2, 2007 to 2011. The global financial crisis hit. Inflation spiked to 10.7% in 2008, then collapsed. The policy rate fell from 13 to 9%. The real rate averaged 4.3%. Volatility was extreme. The CIO who held long-duration bonds through the crisis captured capital gains as rates fell. The CIO who panicked locked in losses. Looking forward from 2011, a CIO would have projected low rates to persist and inflation to remain moderate. The portfolio mix. 30% government bonds, shorter duration now. 20% inflation-linked assets, hedging the commodity risk. 25% equities, post-crisis recovery. 15% T-bills. 10% cash. The real rate was compressing. Diversification became essential. Period 3, 2012 to 2016. Rates stabilized around 10%. Inflation drifted from 6 to 3, then back to 6. The real rate averaged 4.7%. The maximum lending rate began its climb toward 31%, opening a pricing corridor unseen before. The CIO who extended duration at the trough of inflation captured the rebound. The CIO who stayed short missed it. Looking forward from 2016, a CIO would have projected rate stability and inflation normalization. The portfolio mix. 25% government bonds, mid-duration. 25% corporate credit at the maximum lending rate, capturing the widening corridor. 20% equities. 15% T-bills. 10% real assets. 5% cash. The maximum lending corridor was the new opportunity. Period 4, 2017 to 2021. The policy rate hit its all-time low of 7.2% in 2020. Inflation rose modestly from 5 to 6. The real rate averaged 4% but compressed to 2% during COVID. 32 months of negative real rate began in May 2020. The CIO who rotated into real assets before COVID preserved purchasing power. The CIO who stayed in nominal bonds lost silently. Looking forward from 2021, A CIO would have projected rate hikes to combat inflation and a real rate recovery. The portfolio mix: 20% government bonds, short duration only; 25% inflation hedges, real assets and commodities; 25% equities, rate-sensitive sectors rotated; 15% floating rate credit; 10% T-bills; 5% cash. Inflation protection was the priority. Period 5. 2022 to 2024. Inflation peaked at 8.3%, then fell to 6%. The policy rate rose from 10 to 11. The real rate recovered to 4.8%. The maximum lending rate stayed above 31%. The CIO who held inflation hedges through 2022 captured the commodity spike. The CIO who rotated back to bonds in 2023 captured the yield recovery. Looking forward from 2024, a CIO projects rate stability near 11% and inflation moderating toward 5%. The real rate remains positive at 4 to 5%. The portfolio mix: 30% government bonds, extending duration as real rates stabilize; 20% corporate credit at the maximum lending rate; 20% equities; 15% T-bills; 10% real assets; 5% cash. Balanced with a fixed income overweight. This Sankey diagram traces the portfolio flow across all 5 periods. Each band represents an asset class. The width reflects the allocation percentage. Watch how bonds shrink during the crisis years and expand during stability. How equities grow in recovery and contract in uncertainty. How T-bills serve as the flexible buffer. The portfolio breathes with the cycle. The CIO who reads the flow wins. This heat map shows every year from 2002 to 2024. The top row is the policy rate. The middle row is inflation. The bottom row is the real rate. Green means the real rate is high, favoring fixed income. Red means it is low or negative, favoring real assets. The pattern is clear. Lesotho offered positive real rates almost every year. The exceptions were the COVID years, 2020 to 2022. That was the signal to rotate. 5 periods. 5 sets of decisions. The data tells the story. The CIO who tracked the real rate, adjusted duration, rotated between nominal and real assets, and used T-bills as the buffer would have outperformed across the full 23-year cycle. The evidence is in the numbers. The framework is in the real rate. The decision is yours.